Warning: why you are now uninsurable and who is buying your risk. The certified letter hit on a Tuesday. Non-renewed. High wildfire risk. 30 days to show proof, or the lender would force a place insurance at 2 to 5 times last year's premium. Escrow couldn't cover it. The servicer warned her payment would jump $1,100 next month. Missed twice, and delinquency flags land. 11 years of payments and equity now sat on a 30-day clock. She held an envelope that could erase a decade in one billing cycle. Here's the question that matters. What if risk modeling isn't just math? What if it's the new foreclosure lever, priced upstream long before your letter prints? The uninsurable map. Who's pulling coverage and why? That letter felt personal. The spreadsheet didn't. To see why it landed now, map the players. On one side, a family with a roof, a payment, and a mortgage covenant that says you must keep insurance, always. On the other, carriers, reinsurers, and permanent capital setting appetite. Ziep. By Ziep. Penju by Ziep stist me Ziep. Penju compromise, Ziep. Zip by Ziep. Shorn fall. And prosh- and aspp fells prosh- me Ziep. Since the late 2010s into the 2020s, catastrophe losses stacked. Reinsurance hardened. Capacity shrank. Carriers pruned quietly, higher deductibles. Peril carved nouts. Roof niche bans. Wildfire exclusions creeping in. Flood got pushed to separate markets. You paid more for less, then watched the less vanish. Meanwhile, something big shifted upstream. Permanent capital met insurance. Apollo tied itself to a theme. KKR bought Global Atlantic in the 2020s. Blackstone took on life blocks from Allstate and AIG and manages assets for Resolution Life. Harvard Business School summed it, permanent capital meets private markets. The IMF flagged concentration risk as Blackstone, Apollo, and KKR grew into the life and reinsurance stack. Translation for your kitchen table: capital loves predictable spread. Solvency and returns come first, affordability trails far behind. Here's how that touches your mailbox. Primary insurers don't keep all the risk. They buy treaties from reinsurers, who then hedge with retrocession and insurance-ly linked securities. When treaty prices jump at January 1 or mid-year renewals, retail follows months later. Appetite narrows for bad ZIPs, old roofs, dead-end canyons, coastal slabs sitting inches too low. Rating agencies police it through combined ratios and modeled tail risk. Models from RMS and AIR worldwide feed those ratings. Quiet dials return periods, climate adjustments, correlation multipliers, and shift premiums and push non-renewals. The output turns into policy. Because the model code sits behind trade secrets, de facto redlining can wear a hazard score mask, even where local loss history doesn't match the spread. Families feel it as a letter. Lenders feel it as a covenant. Servicers get one job on hazard insurance: no lapse. If proof drops, they must force a place coverage at your expense. Those lender-emplaced policies are 2 to 5 times retail with thin cover. You don't shop them. You just pay them or don't. Then, late fees, escrow shortages, and default mechanics start. Regulators hit abuses in the 2010s, but the core rule stands: no proof, they place it. Your payment jumps mid-year. Your DTI looks worse. Your refi dies. Options shrink. Now, look at the early winners. Surplus lines carriers slide into gaps. Specialty MGAs quote, selective perils at selective prices. Private credit fills quota shares and sidecars, earning double-digit yields on insurance risk without ever sitting at your kitchen table. It's a tidy loop. Capital tightens reinsurance. Models tighten appetite. Carriers prune. Retail thins. Households scramble. Servicers force. A place. Fee stacks grow, and the parcel's risk data flows back upstream. Who profits when you can't carry the new bill? Here's the knot most people miss. The same investors building insurance and reinsurance platforms also sit in single-family rental and housing credit. SFR operators map buy boxes by yield and risk. Clusters of non-renewals, roof age, claim density and lender-emplaced spikes become heat maps for distress. Self-insured landlords buy master programs, carry bigger deductibles, and diversify across metros. What crushes a household pencil out is manageable to a fund. Is this just climate? Hazard is real in the 2020s. But incentives steer decisions. When capital must hit spread targets, the easy dial is appetite. Exclusions over mitigation. Non-renewals over grants. Percentage deductibles over funded vents and Class 4 roofs. In adjacent zips where fuels don't change much, quotes can still flip. Because the model says no here and maybe there. That isn't a wildfire moving a mile. That's policy. Micro story. A servicer's bought flags missing proof. 30-day letters go out. Meanwhile, the carrier's renewal algorithm, fed by a fresh wildfire score and a third-party roof midge guess, withdraws appetite. The broker appeals. The file sits. The servicer doesn't wait. Lender placed hits. Escrow recalculates. The payment spikes. A credit ding lands when the shortage isn't cured. Across town, an acquisitions analyst filters MLS cuts and NODs against a map of insurance non-renewals. The overlap becomes a call list. From a porch, the map looks unfair and fast. In a deck, it looks rational. Risk costs more. Capital follows rules. Households are price takers. But rules are built by incentives. Today, incentives reward pulling capacity rather than funding resilience. So, who's actually pulling coverage? Start with carriers constrained by reinsurance price and rating guardrails. Add reinsurers and ILS investors who demand portfolio discipline, which reads as roofmage limits, tighter wildfire scores, higher first dollar pay. Layer permanent capital, Apollo, KKR, Blackstone, sitting inside liability engines that prefer predictable spread. Then end at your servicer, whose compliance clock beats human appeal queues every time. That certified letter didn't start a fire. It framed a choice: pay more for less, pay a lender for thin coverage, or fail the covenant and watch equity convert to inventory. We're going to walk the supply chain next. Primary, reinsurance, retrocession, private credit, to show how appetite gets set. Then we'll crack the kitchen the block of box models and make the quiet dials visible. After that, we'll open the hidden foreclosure lever force of placed insurance and its exact timelines. Finally, we'll follow the money from policy to property, because someone is buying the risk you couldn't carry. Supply chain of risk: primary, reinsurance, retrocession, private credit. To see how a letter becomes policy, follow the risk. A family pays premium day one. The primary carrier pockets an expense slice, books the rest, and decides what to keep and what to pass upstairs. Survival here means a combined ratio under 100. Checks go, when hail stacks or fire years run long, that ratio blows out. The fast fix isn't raise everything. It's cut appetite. Old roofs, canyons with one road, coastal slabs a foot too low. Trim them until the book looks sane again. Meanwhile, the weather for carriers is set in another room: treaty renewals. Once or twice a year, often January 1 or mid-year, insurers buy reinsurance. After the late 2010s into the 2020s loss run, reinsurers raised prices, pushed up retentions, and narrowed terms. Where carriers once had fat cushions, they now keep more skin before cover attaches. That change doesn't hit your mailbox tomorrow. It hits when your renewal arrives months later and the appetite screen blinks red on your zip. Reinsurers hedge too. They buy retrocession, pass slices into collateralized reinsurance, and tap insurance in linked security. When cat years turn rough or Model 80 actual slippage spooks investors, capital in those funds shrinks or demands higher coupons. You'll hear capacity shortage and tightened terms. Translation: the umbrella got smaller and the rent went up. Primary carriers absorb that math, then look for dials they can turn fast. Deductibles become percentages. Perils get carved. Roof wage cutoffs harden. Cat bonds hum in the background. Pension money and others love uncorrelated yield. right up until inflation and loss creep remind them correlation isn't zero. Coupons rise, sponsors pay more. Sponsors then walk back to the underwriting desk and say, "Be stricter." Discipline reads polite in a prospectus. In your kitchen, discipline looks like no quote. Now add permanent capital to the stack. In the 2020s, Apollo tied up with a theme. KKR bought Global Atlantic, and Blackstone managed giant life blocks and mandates alongside Resolution Life. Harvard called it permanent capital meets private markets. The IMF flagged concentration. What it means in practice: balance sheets that, like spread and duration, now sit inside insurance. They steer liabilities toward assets, and assets back toward liabilities. If RMS or AIR says a tail fattens in your region, and ratings agree, capacity flows away. Because target spreads matter. Rating agencies are the lane lines. To keep an AU- or better, carriers must manage modeled tail risk. That means living inside vendor curves' annual average loss, 1 win 100, 1 win 250, climate adjustments, correlation tweaks. Quiet dials that regulators don't see in code but do see in filings. If including your ZAP bumps a 1 in 200 above an internal guardrail, appetite closes. It isn't personal, it's capital planning. There's a cash flow twist that rarely gets airtime. Premiums arrive up front. Losses lag. In the low-rate decade, investment income couldn't save sloppy underwriting. In the 2020s, higher yields tempt carriers to chase spread again. Kink, but only if volatility doesn't blow up capital. The easiest way to hold capital steady? Move first. Dollar pain to you. Raise deductibles. Exclude marginal perils. Thin coverage so balance sheets sit in safer assets while households eat the near-term shocks. Private credit steps in where missing capacity lives. Quota shares and sidecars let outside investors take a fixed % of premiums and losses from a defined book. Offer mid to high teens returns. And those investors want a cleaner portfolio before they sign. Clean equals fewer old roofs, stricter wildfire scores, higher percentage deductibles, narrower flood. The portfolio looks prettier. Your block looks harder. Meanwhile, surplus lines and specialty MGAs bridge retail gaps with price points only some families can swallow. They're nimble, often backed by the same capital that sits upstream. Selective perils at selective prices. Admitted markets say no. Excess and surplus says maybe, with terms. Lender-owned placed adds a floor to the whole machine. Servicers must show continuous coverage. If proof lags, a vendor places a policy, often 2 to 5 times retail, backdated to the lapse, paid through escrow. That floor is comforting to reinsurance and private credit because it stabilizes loss funding even when consumer markets wobble. It's brutal at your table when the payment jumps mid-I cycle. So, line up the chain. Primary underwriters build to a target combined ratio, inside ratings guardrails, using vendor models that push tail caution. Reinsurers price treaties with higher retentions and stricter terms after rough seasons. Retrocession and cat bonds shift with investor nerves and inflation drift. Private credit fills quota shares and sidecars at yields that require portfolio discipline you'll meet as exclusions. Permanent capital platforms, Apollo, KKR, Blackstone optimize, spread across insurance balance sheets. Which means appetite follows model math, not neighborhood nuance. And when retail collapses in a ZIP, force placed keeps the collateral insured and the cash flow predictable, even if households can't breathe. From a distance, it's elegant. Risk is sliced, priced, and sold to the balance sheet best built to hold it. Up close, it's a letter, a 30-day clock, an escrow spike, and a buyer with a master policy who can carry what you can't. The black box cat models, climate data, and redlining too. If capital sets appetite, models set the menu. So let's open the kitchen. Picture a clean interface on a second monitor. WAR RMS or AIR worldwide. Left side inputs. Hazard, exposure, vulnerability, replacement cost. Right side outputs. Annual average loss. 1 win 100 and 1 win 250 tails. Probable maximum loss. In between, a row of quiet dials that decide whether your agent can even hit quote. Start with hazard. That's fuel, slope, wind speed, hail frequency, storm surge depth. Then exposure. That's your parcel in inches, not vibes roof type, year built, distance to a hydrant, driveway length, eave overhang, defensible space. Vulnerability converts wood, asphalt, stucco, vents and attachments into curves. How a Class 4 shingle behaves at 80-mile gusts. How embering-proof vents cut intrusion odds. Replacement cost layers labor rates, code upgrades, inflation drift. One wrong number and the whole sheet shifts. Change a dial and the future gets heavier. Turn on climate adjustment and nudge severe e-convective storms up a notch. Set return periods from 1 in 100 to 1 in a 250 and fatten the tail. Tie drought, heat, and wind closer with correlation multipliers so bad years cluster. Link adjacent Z-ops so your ridge inherits a neighbor's burn scar risk. None of that is a headline. It's a checkbox. But when rating agencies police tail risk, those checkboxes become law for underwriters trying to keep an A-. Here's the catch. The sausage is secret. The model code sits behind trade secrets. Regulators see filings and exhibits, not source. Anti-redlining rules police outcomes, not the logic inside. So when two blocks with similar loss history see spreads move miles apart across a city line, it reads like nature. It might be a dial. Swap in a vendor roof midge table trained on newer suburbs, and a 1940s grid ages 5 years overnight. Pull a wildfire score from a vendor that never walked your canyon, and a cul-de-sac jumps a tier because lidar saw vegetation density, not irrigated shrubs. AI speeds the triage. Pre-renewal pipelines now ingest aerial imagery, assessor parcels, building footprints, roof condition scores, vegetation index, driveway length, deck attachments, even the shadow of a pine near an eave. The bot assigns a roof score, flags vent types, estimates clearance, then routes files into fast lanes or no appetite. Appeals wait in a queue. The servicer's 30-day clock doesn't. This is how de facto redlining hides in a hazard hoodie. Models lean on proxies roof age, lot size, hydrant distance, driveway length, that correlate with race, income, and older housing stock, without naming them. Urban heat islands packed with 1940s roofs get vulnerability bumps. Hail belts with patchwork shingle histories show loss creep. Coastal fill with shallow utilities shows surge uplift. If mitigation money never reached those blocks, yesterday's gaps become tomorrow's premiums. If an appeal requires a third-party inspection you can't afford, the default stands. Meanwhile, rating agencies lock alignment. To protect capital, carriers must show their 1-1 in. 200 won't blow guardrails when climate drift and correlation stack. That forces portfolios to discipline fewer old roofs, tighter wildfire scores, higher first $1 pain. Reinsurers ask for the same curves at treaty renewal. Sidecar and cat bond investors want mid-high teens returns uncorrelated with equities, which means sit-ins must clean books before paper sells. Clean on a slide reads as strong underwriting. Clean at your sink reads as no quote. Does mitigation help? Yes, if the model sees it. Proof beats hope. Class 4 roof with invoice and photos. Ember-proof vents documented with a contractor note. Defensible space mapped with dated pics and a tape and frame. Hydrant distance measured, not guessed. Closed permits attached. Without receipts, the pipeline assumes old, risky, and unchanged. With receipts, a junior underwriter can override a roof flag and drop 8% to 15%. Not heroics, paperwork. Micro-story. 2 bungalows on the same 1940s block. One replaced a roof last summer, added ember vents, cleared 30 feet. They saved invoices and shot dated photos. The neighbor plans tack-tack. The model ingests aerials, sees dark shingles on both, and a vendor table tags 18 years of roof age. A dry winter bumps the wildfire score. The bot spits a 34% hike with a 2% wind deductible. Family 1 uploads a packet invoice, photos, inspector note. An underwriter removes the roofage penalty and trims 11%. Family 2 misses the appeal window. The servicer force up. Escrow spikes next bill. One more layer. Data errors compound. Third-party records guess roof year, siding, distances, sometimes wrong by a decade. Dispute needs proof assessor pages, permits, invoices, dated images. Ask your agent to push a data correction endorsement. It's boring. It's everything. So what's the fix? Sunlight on the dials and receipts in your file. Model transparency laws face trade secrets. Surplus lines dodge many rate controls. Rating pressure won't ease after rough 2020 seasons. But households can still flip attributes that matter to the box harden where the model looks. Then submit a clean packet early. Communities can standardize Class 4 and ember vents, mow hydrants, mark addresses, and certify it annually. Underwriters like disciplined clusters. Appetite reopens a crack where blocks move together. Because the black box isn't one villain. It's layers vendor code, climate drift, rating math, and capital that prefers cushions over nuance. If you don't feed it facts, it feeds on defaults. If you do, you can move a dial the bot already uses. Force-placed insurance. The hidden foreclosure lever. Coverage drops. Lenders don't wait. Here's the lever. It starts as a routine letter, .co, we don't have proof of hazard insurance. Your mortgage has one hard rule, keep continuous coverage. If you don't, the servicer may place it at your expense. That's the whole game. Pricing first. Because this is where budgets snap. Lender-placed, also called force-placed, typically runs 2 to 5 times what a normal homeowner policy costs. And it's thin. It protects the lender's interest in the structure, not your life inside. Contents? Often no. Liability? Often no. Water backup, matching, ordinance or law? Don't count on it. You don't shop it. You don't pick endorsements. You just pay it or it posts anyway, and your escrow has to catch up. The timeline is faster than you think. Day 1 notice sent. Day 30, if no acceptable proof is on file, the policy is placed and backdated to the lapse date. That means you're billed for days you never chose. Around day 45, escrow analysis runs. The servicer spreads the shortage and the new annual premium across the next 12 months. Your total payment jumps mid-year. Day 60, if you didn't pay the new full amount, the account shows delinquent. Late fees land. Credit can take a hit. Miss again, and default mechanics wake up. Micro moment. A family emails a binder on day 33. The vendor inbox is backed up. The system doesn't see it. LPI posts. Escrow recalcs. Their autopay sends the old total, which the portal treats as partial. A white envelope with bold block type arrives 3 days later. They're technically past due over a data lag. Why does this exist? Servicers answer to investors and bank examiners. The rule is safety and soundness collateral must stay insured. So the machine outsources the gap to you. Retail market failing you isn't an excuse in that rulebook. If admitted and surplus lines won't bind fast enough, the vendor will. There's a quieter money trail. LPI programs pay administrative fees to servicers or affiliates for tracking, placement, and monitoring. Regulators cracked down on the worst practices in the 2010s. Consent orders and all, but the core power stands, no proof. They place it. Vendors get steady premium flow. Servicers stay compliant. The borrower absorbs the shock. Backdating is the knife twist. If your policy lapsed 2 weeks before the letter, the LPI will start there, then bill forward. That back-billed chunk becomes an escrow shortage that spreads over 12 months, unless you post a lump sum today. A $3,600 advance shows up as $300 extra per month, on top of a higher ongoing premium. That's how a kitchen table budget breaks on a random Tuesday. Now fold in mortgages. ARM's resetting plus an escrow jump is a 1-2 hit. Your debt-to-income ratio looks worse on paper. right when you need a refi or HELOC to fund the Class 4 roof and ember vents that would lower future quotes. The covenant meant to protect the house ends up blocking the fix. Here's where it links back to the black box. Non-renewals cluster by ZIP. Roof age, access risk. Those clusters create pools of borrowers more likely to hit a forced lapse. Insurance tracking data doesn't just resolve flags. In aggregate, it maps distress. Acquisition teams in single-family rental and note funds buy those maps. Opportunistic isn't a villain word. It's a spreadsheet column. Human beat. A borrower binds a fair plan on day 52. They upload, email, and call. The vendor's service level agreement says 10 business days to process. Meanwhile, November's bill posts with the LPI still on the ledger. They pay principal and interest in full, escrow short, hoping grace covers it. It doesn't. A late fee lands. 2 weeks later, the LPI cancels retro to the fair effective date. A refund drops into escrow. The servicer recalculates again. The family breathes. It took 5 calls, 3 uploads, and a complaint to the state. So, Counterplay. Speed is oxygen. Ask your agent for a binder with exact effective dates. Upload it and email it the same day. Call and get a ticket number. If retail won't bind, apply to your state's fair plan immediately. A pending receipt can pause placement if you push. If LPI hits anyway, do not skip the new full payment blindly. Turn off total due autopay while it settles. Pay principal and interest on time. Pay as much escrow as you can. Then, when real coverage binds, demand cancellation retro to the start and a full escrow refund. Put it in writing. If the vendor stalls, file a complaint with your state insurance department and the CFPB portal. Paper moves what phone calls can't. Fix the file. The model penalized roof age and vents it couldn't see. LPI punishes proof it didn't get. Title your PDA FAF, proof _of insurance _. Train crews, Dakarastrabev _. Nang unbe scratch. On lawsuits. Deco dequans. Attach the binder, declarations, and a short cover line with loan number, property address, effective dates. Keep every ticket ID. One last truth. LPI isn't a glitch. It's a floor that keeps collateral insured and investor cash flows smooth when consumer markets wobble. From 30,000 feet, that's stability. Keep at your sink. It's a lever that can pry equity loose in 60 days. If you treat it like junk mail, it wins. Who's buying your risk? If you treat it like a court policy to property, keep your house. Follow the letter's data trail. It doesn't stop at your mailbox. It moves upstream, gets cleaned, scored, and comes back down as a buy list. The players aren't hiding. They're the same names shaping insurance appetite at the top of the stack. Apollo with Athene, KKR with Global Atlantic, Blackstone managing giant life blocks and mandates. Harvard called it permanent capital meets private markets. The IMF flagged concentration. In plain English, tend you. The people who price your risk also finance the buyers who can carry it. Start with what the systems actually see. Non-renewal clusters by ZIP. Roof wage flags. Lender-replaced insurance counts and timing. Fair plan applications by month. Delinquency nibbles right after escrow jumps. None of that is a family story. It's columns. When those columns stack, they mark neighborhoods where owner budgets stretch, lender clocks tick, and listings are more likely to read as is. Now look at the buyer. Single-family rental operators don't need your one-policy solution. They buy insurance at scale master programs with higher deductibles and strict exclusions they can manage. They spread wind and hail volatility across thousands of doors. They pair base coverage with parametric riders that pay fast on wind speed or quake magnitude, not after months of adjuster fights. What would crush a household's cash flow becomes portfolio noise inside a fund. Micro emolment. A servicer's vendor flags a spike in lender, placed across 2 suburban zips on a wildfire edge. An SFR analyst layers that map over MLS price cuts, roof permits, and days to close trends. The overlap becomes a list of houses more likely to need a quick exit. The buyer calls agents with one script cash. Short inspection, as is, close in 14 days. It lands because the seller is staring at $1,100 escrow jump and a letter that says 30 days. Here's the upstream echo. The same capital building insurance and reinsurance platforms need steady assets to hold mortgages, rental homes, credit. Insurance data feeds where those assets are safest to buy cheap and hold long. Nobody needs a secret meeting. It's all incentives. Tighten appetite in fragile zips. Keep collateral insured with lender-emplaced floors. Watch distress appear. Step in with patient cash. Self-insurance finishes the loop. A landlord will eat a $100,000 cat deductible once every few years and be fine. A family with a 2% wind deductible on a $500,000 insured value won't. 9 or 10 grand cash before help arrives is a budget crater. So the platform writes terms a household can't, funds repairs at bulk rates, and resets rent to carry the risk over time. Same wind, different balance sheet. Is this just climate? Hazard is real. But watch timing tells that don't track weather. Reinsurance renewals hit January 1 or mid-year. Model vendors ship new versions. Appetite screens shift within weeks. Letters bunch by algorithm, not by storm. 3 months later, price cut listings rise in the same pockets. That's policy turning into property. One more scene. A 1970s cul-de-sac in a hail belt. Renewal quotes land with 2% wind/hail deductibles and roof ACV riders. 4 owners can't float a roof this year. One misses proof during a job change. Lender placed hits. The payment jumps mid-cycle. An acquisitions rep walks the block at dusk, knocks softly, and leaves a card. No pressure, they say. Just options before the clock gets loud. 30 days later, a deed moves to an LLC tied to an SFR platform. The sign never says the parent name you know. The insurance sits on a master policy you'll never read. Why this works comes down to floors and funnels. Force-placed insurance is a floor under collateral coverage. It protects the note and keeps loss funding predictable for investors even when retail breaks. That predictability is yield. Yield attracts permanent capital. Permanent capital wants more places to park itself. Rental homes make sense when mortgage rates cool, or when families trapped by escrow spikes need out. The funnel is the data risk scores, non-renewals, LPI waves, and quick-a-close flags flowing from policy desks to property desks. Does anyone collude? You don't need a conspiracy when spreadsheets rhyme. A model pushes tail risk higher. A rating guardrail narrows appetite. A servicer enforces a covenant on a 30-day timer. A buyer armed with patient cash and cheap scale insurance offers relief that fits their numbers. Every step looks rational alone. Together, it moves ownership. So what do you do with that? Map the end buyer like you mapped the carrier. If SFRs are active in your zip, assume quick offers arrive right after insurance shocks. Decide now what number would make you sell, and what cash you'll keep on hand to ride a spike. If staying is the plan, build the boring moats funds can't copy documented Class 4 roof, ember vents, defensible space. Ordinance or a law bumped to 25% or 50%. ALE tall enough to survive contractor delays. Bind a fire backstop fast if you need to pause a lender-unplaced clock. Keep a dedicated deductible fund so a 2% clause isn't a sale. Because someone will buy your risk if you can't carry it. Today, that someone likely buys it with money that also priced the letter you're holding. The climate alibi versus incentive math. They'll say it's the weather. And yes, hazard is up. Fires burn hotter in the 2020s. Hail bands widened. Flood maps changed. Nobody honest denies that. But here's the rub. Climate is the backdrop. Incentives write the script. When reinsurance gets pricier and rating guardrails tighten, someone chooses which lever to pull. Grants or exclusions, mitigation or non-renewals. Lower deductibles paired with upgrades or percentage deductibles that shift first dollar pain to you. Over and over, the system picked the lever that protects spread first. Start with timing tells. Reinsurance treaties reset January 1 or mid-year. Model vendors push new versions. Within weeks, appetite screens flip across whole ZIFs. Your roof didn't age 5 years in March. A checkbox moved. If it were purely weather, the gradient would look like fuel maps, not filing calendars. Now watch adjacent zips. Same ridge, same fuel, same hydrant distances. One code says no, the next says maybe. That isn't a fire marching a mile. That's a portfolio optimizer keeping a 1 in 200 loss under a rating threshold. Climate explains why the baseline rose. Incentives explain why the edges got cut first and fastest. Deductibles tell the truth in plain numbers. A 2% wind deductible on $500,000 is 10 grand cash before a dollar pays. Most families don't have that. Platforms do. Self-insured landlords spread deductibles across thousands of doors, buy master programs, and use parametric covers that pay on wind speed or quake magnitude. Same storm, different wallet. Incentives reward terms households can't carry and funds can. Force-placed insurance is the loudest quiet proof. If retail quotes are unaffordable, the servicer doesn't freeze your cost and call a task force. They place a policy at 2 to 5 times retail, backdate it, and roll the shortage into escrow. That isn't climate. That's a rule that guarantees cash shows up upstream on time. Investors love floors. Floors stabilize returns. Your budget eats the shock. Models wear the alibi well. RMS and AIR add climate adjustments, fatter tails, tighter correlations. Sensible for solvency. But those dials live behind trade secrets. Regulators see filings, not code. Anti-redlining laws police outcomes, not math. So proxies roof age, hydrant distance, lot size, map to older housing and lower incomes without saying so. If mitigation dollars never reach those blocks, yesterday's disrepair becomes tomorrow's surcharge. That's not a storm. That's history priced forward. Permanent capital sharpened the tilt. In the 2020s, Apollo merged with Athene. KKR bought Global Atlantic. Blackstone managed life blocks and mandates. Harvard called it permanent capital meets private markets. The IMF flagged concentration. These platforms love predictable spread. They hold both sides of the pipe liabilities in insurance, assets and credit, and housing. When a model says a tail fattens, appetite moves. When a letter lands, a buyer with patient cash and scale insurance stands nearby. No conspiracy. Look for the 3 beats that repeat: treaties reprice, models update, appetite shrinks. Months later, non-renewals bunch. 30-day clocks start. Escrow spikes. Listings go as is. Cash closes fast. If it were only climate, you wouldn't see the cadence. You'd see chaos. Instead, you see cycles with calendar teeth. None of this excuses hazard. Fires are real. Hail shreds roofs. Flood eats drywall. So fix what the box sees. Class 4 shingles with invoices and photos. Ember-proof vents with a contractor note. Defensible space measured, not guessed. Ordinance NARA law up to 25% or 50%. Additional living expense tall enough for a slow rebuild. Proof moves dials. Hearsay doesn't. But personal fixes won't rewrite incentives alone. That's where pressure matters. Model transparency rooms under confidentiality. Let regulators audit the dials that decide appetite. Standard, portable mitigation credits take your roof and vent wins between carriers. Guardrails on force, unplaced tight processing clocks. Clean retro refunds. Limits on backdating shock. Specimen forms posted, not just quote sheets. Let families see roof ACV riders, matching, and percentage clauses before they bind. And build local leverage. HOAs standardize Class 4 and Ember vents. Mark hydrants. Clear egress. Certify it every spring. Underwriters like disciplined clusters. Appetite reopens a crack when a street behaves like a portfolio. So, is it climate? Yes, and incentives. The equation you're living isn't just hazard times exposure times vulnerability. Add I for incentives. ROE, FAE. Right now, I leans caution with I yield. Known 10 sheet, FA cash. That turns small model nudges into big kitchen idable bills. Tilt I toward resiliency with A coverage. And dollars move to roofs, vents, and defensible space before a letter prints. The weather didn't choose your deductible. A spreadsheet did. Household counter moves. Mitigation, fair, captives, co-ops. Coverage slips, clocks start, and spreadsheets don't care. So you move first. Think 90-day shield, fast mitigation. Bind a backstop, fix bad data, and buy time while you breathe. We're stacking real steps, not vibes. Keep receipts. Name files clean. Beat the bot with proof. Start where the model stares. Roof, vents, edges, and space. Class 4 roof if you're replacing anyway. If not, tighten what you have. Repair lifted shingles. Reflash penetrations. Seal soffit gaps. Ember-proof vents next. Cheap win. Big signal. Create defensible space. 5 feet non-combustible, 30 feet clean, then lean and green to 100 where you can. Trim limbs off the roof line. Clear gutters. Measure hydrant distance and driveway width with a tape, not a guess. Document like a claim you want to win. 12 photos minimum front, back, both sides. Ridge, vents, soffits, gutters, clearance, hydrant tape, driveway tape. Put today's date in frame a phone lock screen or newspaper. Grab invoices and a one-page note from a licensed contractor confirming Class 4 install, Ember vents, and clearance. Title, the PDF. Mitigation_packet_. Send it to your agent and ask for a named underwriter review. Be specific. Remove roof midge penalty, add Ember event and hardening credits. Expect 8% slide, 15% movement when proof lands. If the quote still stings, build a price file. 3 apples, toe happles quotes on coverage A, B, C, D, and deductibles. 1 admitted if possible, 1 surplus lines, 1 fair plan. Ask for specimen forms, not just a summary. You need to spot roof ACV riders, percentage wind deductibles, matching exclusions, and Uninsurable law limits. Push Uninsurable law to 25% or 50%. Bump additional living expense to 18-24 months or a higher cap. Add water backup and service line. Kill roof ACV if you can. If not, budget the gap. Now the backstop. If lender unplaced is looming, bind something fast. The fair plan is the pause button. It's often pricier and thin on extras, but a binder with exact effective dates stops the servicer's clock. Upload the binder to the portal, email it, and call for a ticket number. Say it out loud. Will this binder pause force a placement and reverse any pending LPI? Get the name and the yes. Parametric add-ons are your deductible slush fund. Wind above XMC, quake above Y magnitude, flood depth above Z feet. They pay on trigger, not adjuster haggles. Pair a higher I-deductible base policy with a small parametric policy that fires cash in days. That covers hotels, tarps, and your big percentage deductible without a 6-month stare-down. Data cleanup is quiet power. Third-party tables misgauge roofs and miss a measure distances all the time. Ask your agent for the negative attributes on file: roof year, vent type, clearance, hydrant. Dispute wrongs with proof assessor pages, closed permits, invoices, dated photos. Request a data correction endorsement and a named underwriter re-rate. Boring? The difference between 34% up and 18% up? Also yes. Money triage next. Open a high-yield savings labeled deductible_fund_FARC. Seed it with whatever's real, $500, $1,000 sick, and automate $100 a month. A 2% wind deductible on $500,000 is 10 grand cash. Don't hope, fund it. Then ask your servicer for an escrow projection with scenarios. so you know the new total and the shortage spread if LPI hits. Turn off total, it do auto pay during churn. Pay principal and interest in full. Pay escrow as much as you can. Avoid partial, late flags caused by portal math, not bad faith. Captives? Slow down. A captive is an insurance company you own to insure your own risk. It needs scale, real risk transfer, and careful tax work. For one house, no. For a small portfolio or HOA with seasoned counsel and clean governance, maybe over 12-18 months, not 30 days. If your HOA wants leverage sooner, build a deductible co. Op neighbors contribute monthly to a transparent fund that covers everyone's percentage deductible after a declared event. Pair it with standards, Class 4 on replacement, ember vents required, 5U-foot non-combustible zone, reflective address signs, and hydrant clearance. And certify annually. Underwriters like disciplined clusters. Co-op the shopping too. 5 to 50 homes, 1 independent agent, pre-validated mitigation packets, and a pre-priced menu of carriers willing to quote the street. Ask the agent to negotiate managed repair opt-outs, ordinance or law minimums, no roof ACV, and matching endorsements as defaults. You're not special. You're standardized. That's the point. Micro win sprint. Day by day. Days 1-3. Pull policy and endorsements. List percentage deductibles, roof ACV, matching, ordinance war law, ALE. Request loss runs and negative attributes. Start photos. Days 4-7. Fix soffits, clear gutters, trim limbs, install ember vents. Shoot dated photos. Get contractor note. Send mitigation packet to agent for credits and re-rate. Days 8-12. Build price file admitted. Surplus. Fair. Ask for specimen forms. Push O&L to 25 per plus. ALE to 18-24 months. Water backup, service line, matching. Day 13. If the servicer's letter exists, bind fair. Upload, email, call, get ticket. Pause autopay. Ask for escrow projection scenarios. Days 14-21, once. Dispute bad data with proof. Request data correction endorsement and named underwriter review. Open your deductible fund and automate it. Days 22-30, co-op kickoff. Share your packet template with neighbors. Schedule a clearance day and ask your agent for a group quote window. Submit a community certification to carriers. 2 traps to skip. Don't chase a lower premium by accepting a percentage deductible you can't pay. And don't wait for perfect credits before you bind a backstop. Lenders run timers. You run binders, receipts, and cash flow. Last piece scripts. Email subject lines that work. Mitigation packet plus re-rate request. Remove roofage penalty, add ember vent credit. Proof of coverage binder, pause LPI. Chash CAC. Data correction endorsement request. Roof year plus hydrant distance. Short, clear, factual. Staff triages by clarity, you jump the queue by being easy to help. You can't out-argue a model with feelings. You can out-document it with facts. Find something that pauses the lever, and buy enough time to make your house look like the portfolio they still want. That's the shield. Now build it. The policy drift you don't see, exclusions plus deductibles. Even with a yes at renewal, the ground shifts under your feet. It isn't loud. It hides in one-page endorsements and tiny words that move thousands from their column to yours. You think you bought homeowners. You bought a form plus riders that decide how you land after a loss. Start with scope. Older forms leaned all risk and carved out a few clear no's. Now many policies arrive named peril or special with a long exclusions rider. Water splits into buckets. Sudden and accidental is fine. Seepage, repeated leakage, or wind-driven rain under a threshold is out. Smoke may be covered, but ash cleanup in your garage can fall through a gap. Roof dents after hail? The adjuster says cosmetic if it still keeps water out. You'll stand under a pockmarked roof while a desk says function, not finish. Deductibles got clever. The flat $1,000 that lived in your head moved to percentages by peril. Windstorm at 2%. Named storm at 5%. Hail at 1% with a cap you didn't notice. If coverage A is $500,000, that 2% is 10 grand cash before a dollar pays. If coverage A is $500,000, that 2% is 10 grand cash before a dollar pays. Calendar year aggregate sounds friendly, but read closely. 2 storms can each trigger the full percentage if the first loss doesn't hit a cap. You'll learn the rule the day you don't have the cash. Roof ACV riders slipped into hail belts like a weed. They switch your roof from replacement cost to actual cash value depreciated materials. Maybe replacement labor. 10-year shingles? The check lands short of what your roofer quotes. You'll find the difference in your deductible fund or your credit line. Ordinance or law is the quiet killer. Code upgrades aren't luxury, inspectors require them. Without the endorsement, the base policy won't pay to bring wiring, straps, roof-to-wall connections, or wildland-urban interface features up to current code. Many defaults sit at 10% of coverage A. 1 panel and 2 lines of strapping can drain that in a city that tightened code after the 2020s burned. Ask for 25% or 50%. If the carrier balks, price the gap now, not after framing opens. Matching is where claims turn gray. Flooring, siding, shingles, your form may pay to replace only the damaged pieces unless you added a line of sight or matching endorsement. Without it, you live with checkerboard patches and a hit to resale. Most people won't litigate aesthetics. The clause settles the argument before you start. Loss of use, also called additional living expense, reads generous until months pass. Up to 12 months or a dollar cap looks fine on paper. In the 2020s, contractor queues and supply delays push rebuilds past a year. Families run out at month 9 with studs open. Push for time, plus amount, 18 to 24 months or a higher dollar limit. Hotels don't accept "we're waiting on framing." Managed repair networks sound like help. We'll send our preferred contractor. Translation: scope, rates, and materials bend to the carrier's deal. If you opt out, some forms reduce coverage on categories, slow walk under reasonable proof, or hold back recoverable depreciation until every nail is blessed. If you accept, get the opt-out terms in writing first. Don't find out the penalty in the middle of drywall. Water backup and service line are the cheapest riders you'll be grateful you bought. Base forms often exclude both. A $50 to $150 add-on buys $10,000 to $25,000 when a clay pipe fails or a storm pops a cleanout. In older grids, this isn't a luxury, it's Tuesday. Cosmetic loss exclusions on metal roofs and garage doors are spreading. A pea field of hail dings? If the skin still sheds water, some forms say no. If your HOA or your I won't accept dimples, remove that rider or bank the fix. Now the playbook. Ask for the specimen policy, not just a quote summary. Read endorsements first. Make a 1-page checklist. List percentage deductibles by peril and their caps. Confirm roof replacement cost, or flag ACV language. Set ordinance or law at 25% or 50%. Add matching or line of sight where it matters. Raise additional living expense to time plus amount. Add water backup and service line. Get managed repair opt-out terms in writing. Kill cosmetic loss and named storm surprises if you can. Pair form fixes with a cash plan. A lower premium with a 2% wind deductible is a trap if you don't have 10 grand liquid. Build a labeled high-yield account for deductibles. Consider small parametric covers, wind over XM fee, quake over Y magnitude, to drop fast cash when the clause bites. Finally, calendar a pre-renewal review. 60 days out, request your full form, endorsements, and any new riders. Compare last year to this year, line by line. Forms drift in silence. Your 90-day shield. Stop the drift with daylight. Step by step, one clause at a time. This is a sprint, not a stroll. You've got a letter, a lender clock, and a model that rewards paperwork, not panic. We're stacking moves in 4 bursts. Name your files the same way. Get ticket numbers. Beat the bot with proof. Days 170 audit and surface facts. Pull your full policy and endorsements. List percentage deductibles by peril, roof ACV riders, matching, ordinance or law limits, and additional living expense caps. Screenshot the declarations page. Ask your agent for loss runs and the negative attributes on file: roof year, vent type, clearance, hydrant distance, wildfire or hail score. You need to know what the box thinks. Open a folder, address_insurance_2020s. Inside, create ORO1_policy, ORO2_mitigation, ORO3_price file, ORO4_lender, ORO5_regulator. Call your servicer's insurance line. Ask, what pauses LPI here? A binder, a fair application receipt. Get names, dates, and a ticket number. Write it on the folder. Days 8/21. Visible hardening and proof. Hit what the model stares at. Tighten the roof you have. Repair lifted shingles. Reflash penetrations. Seal soffit gaps. Install ember-proof vents. Clear a 5-foot non-combustible zone, then 30 feet clean, lean and green to 100 if you can. Trim limbs off the roofline. Clean gutters. Measure hydrant distance and driveway width with a tape, not a guess. Shoot dated photos, front, back, both sides, ridge, vents, soffits, gutters, 5-foot zone, 30-foot clearance, hydrant tape, driveway tape. Put today's date in frame a phone lock screen or a newspaper. Get one page from a licensed contractor. Confirms ember vents, clearance, roof repairs or Class 4 install if applicable. Sign, license number, date. Build mitigation_packet_address_YYMMDD.pdf. Cover page with bullets. Then invoices. Contractor note. Photos in order. Simple site sketch. Email your agent, mitigation packet plus re-rate request. Address. Remove roof midge penalty. Add ember, vent credit. Ask for a named underwriter review. Save the sent email. Days 22/30. Build the price file and bind a backstop. Request 3 apples-to-apples quotes. 1 admitted if possible, 1 surplus lines, 1 fair plan. Same coverage A, B, C, D. Same limits. Ask for specimen forms. You need to see roof ACV, percentage deductibles, matching, managed repair, ordinance R law, and ALE. Push ordinance R law to 25% or 50%. Raise ALE to 18-24 months or a higher cap. Add water backup and service line. Kill roof ACV if you can. If you can't, price the gap. Title each, quote, underscore. Address, underscore, YYYMMDD. Create a 1-page compare grid. Premium, peril deductibles, roof ACV yes no, ONL %, ALE, matching, water backup. Service line, managed repair opt-out terms. If the lender's 30-day letter exists, bind the backstop now. A fire binder pauses forced placement. Upload to the portal, email the servicer inbox, and call, will this binder pause LPI and reverse any pending placement? Get the yes and a ticket. Days 31/45 escrow forecast and cash flow defense. Ask for an escrow projection with scenarios. With bound premium X, what's the new total? If LPI Y posted, what's the shortage spread? Get the math and the month the jump hits. Turn off total due auto pay until refunds settle. Manually pay principal and interest in full. Pay escrow as much as you can. Portals often misapply partials. Don't let math label you late. Open a high-yield savings labeled deductible_fund_address. Seed it, $500 or $1,000, and automate $100 a month. A 2% wind deductible on $500,000 is $10 grand. Don't hope. Fund it. Fix bad data. Email your agent. Data correction endorsement request. Roof year plus hydrant distance. Address. Attach assessor pages, permits, invoices, dated photos. Ask for a named underwriter re-rate. Days 46, 60, appeals and pressure. If credits didn't land, resend the packet, then ask for specific flags. Remove roof age penalty, see invoice and photos. Add ember vent plus clearance credits. Keep it bullet pointed. If LPI posted anyway, bind real coverage, then send a cancel and refund letter with binder and effective dates. Demand retro cancellation and escrow refund. Copy your state insurance department and the CFPB complaint portal. Paper moves money. Calendar a follow-up for the refund posting and an immediate escrow recalculation. Ask the servicer to waive the late fee created by processing delays. Get names and tickets. Days 61, 75, group leverage and quotes. Share your mitigation packet template with neighbors. Host a clearance Saturday before/after photos, ember vents, reflective address signs, hydrant clearance. Ask one independent agent to open a group window, 5 to 50 homes. Pre-validated credits, pre-priced menu. Underwriters like disciplined clusters. Standardize, class 4 on replacement, ember vents required, 5-foot non-combustible zone. Submit a community certificate with dated photos and a simple map. Send it to carriers and the state. Appetite reopens a crack when a street looks like a portfolio. Days 76, 9-day. Lock the moat. Pair your base policy with a small parametric cover for wind or quake to fund the big deductible fast. Pre-renewal ritual, 60 days out. Request next year's specimen form and endorsements. Compare line by line, peril deductibles, roof ACV, matching, O&L, ALE, managed repair, cosmetic loss, named storm terms. Fix drift now. Script your inbox. Subject lines that jump cues, proof of insurance binder, pause LPI. Hashtag CAC. Mitigation packet plus re-rate. Remove roof mage, add ember vents. Dalintail.cac. Roof ember vents. Data correction endorsement, roof 2021, hydrant 312 theft. Staff triage clarity. Be easy to help. 2 rules. Don't trade a small premium cut for a deductible you can't pay. And don't wait for perfect credits before you bind a backstop. Lenders run on clocks. You run on binders, receipts, and cash flow. Build the shield once, reuse it every spring. That's how you turn a letter into time, and time into leverage. Regulators, backstops, and loopholes. Regulators write rules. Owners write defaults. We'll use both, but know where each breaks. Start with the State Insurance Commission. They review rate filings, watch solvency, and take complaints. On paper, it's power. In practice, solvency comes first. They don't open RMS or AIR code. They see exhibits, not source. If a 2020's filing shows modeled loss trends up and reinsurance costs higher, a 36% hike can track. Affordability isn't the legal test. Staying alive is. Some states push harder. Public hearing calendars. Online posting of rate filings. Required mitigation credits. Class 4 roofs. Ember vents. Defensible space, visible on forms. That helps if you bring receipts. It won't force a yes where capital says no. Appetite thinning by zip, or roof age hides behind portfolio management. Commissions can nudge, rarely command. Residual markets carry the weight when private steps back. Fair plans, citizens, wind pools, beach and hail funds, the last resort backstops. They bind fast so you can pause force. But they buy the same global reinsurance. When treaties harden, fair premiums rise or coverage narrows. After big seasons, assessments show up. The pool saves roofs today, then asks policyholders to refill it next year. Pressure valve, not cure. Flood sits on its own rail. NFIP under risk rating 2. Recalibrated house-by-house elevation, distance to water, and replacement costs drive the number. Some saw drops, many saw jumps. Appeals fix data errors, not sticker shock. Private flood steps into select pockets, steps out after a loss year. Backstop remains NFIP, price to risk, not to your paycheck. Force, a placed oversight, looks busy, and leaves the spine intact. In the 2010s, the OCC and others hammered banks for kickbacks and junk fees in lender-in-place programs. Scripts changed. Disclosures grew. Today, the rule remains no proof. Place coverage often 2 to 5 times retail. Backdate it. And draft escrow. Safety and soundness examiners check process and timing, not whether the price will break a kitchen table. That isn't their lane. Model opacity hides behind trade secrets. States can ask for justification. Vendors say intellectual property. Anti-redlining laws ban discrimination by race or class, but models lean on proxies, roof age, hydrant distance, lot size, access, that map to older housing and lower incomes. Proving intent is hard when outcomes wear a hazard score. Model transparency bills hit security and innovation walls. Hearings end. The dial stays behind glass. Surplus lines are a legal side door. When admitted markets won't quote, E&S steps in. Many state rate controls and form approvals don't apply. That's why you get a maybe there when admitted says no. It's relief with fewer guardrails. Forms can run lean roof ACV riders, big percentage deductibles, tight managed repair language. Arbitration clauses pull fights off the street. Policy disputes often land in private rooms. Some states ban pre-dispute arbitration in insurance, but vendor contracts for tracking, aerial data, and portals sit outside insurance law. If a bad roof age table triggered your non-renewal, you'll argue terms of service while the lender's 30-day clock runs. Preemption lurks. Federal banking rules shield servicer processes. State insurance rules can't crack them easily. Backstops have their own reinsurance exposure. Fair and wind pools buy cat layers. After rough 2020 seasons and inflation drift, cat coupons rose. Sponsors pay more, then demand stricter underwriting from the primaries. The loop returns to your mailbox. Residual plans adjust with surcharges and narrower forms to survive the next hit. There are bright spots. A few commissioners force carriers to recognize ember vents and Class 4 roofs consistently. Some mandate online specimen forms so exclusions can't hide. NFIP's community rating system cuts flood premiums when towns clear culverts, add tide valves, and map drains. Those moves work because receipts move dials the model already uses. Policy ideas with teeth exist. Confidential audit rooms where regulators inspect model dials. Portable mitigation credits you can carry between carriers. Ordinance, law minimums so code upgrades don't bankrupt you mid-claim. Guardrails on lender, unplaced backdating, and strict 10 business day clocks for processing proof. Retro refunds straight to escrow, immediate recalcs, penalties if missed. And then, loopholes. Managed repair networks baked into endorsements tilt scope and materials. Roof ACV riders creep into hail belts as stability tools. Percentage deductibles normalize. Cosmetic loss exclusions carve metal and doors. Each clause is small. Together, they shift thousands. So use what you have. File complaints with packets, not paragraphs. Attach your mitigation photos, invoices, inspector notes. Ask for the risk attributes driving your quote and a named underwriter review. In flood, fix data, get elevation certs, chase CRS points at City Hall. In fire and wind, package hardening like evidence for court. When servicers stall on cancel hand I refund, copy your state insurance department and the CFPB. PDFs move money. Community leverage matters. HOAs can adopt Class 4 only on replacement. Ember vents, 5-foot non-combustible zones, reflective addresses, hydrant clearance. Certify it annually and send the packet to carriers and the commissioner. Underwriters like disciplined clusters. Appetite reopens a crack where a block behaves like a portfolio. Regulators keep the system upright. Backstops buy time. Loopholes stay open until pressure closes them. You won't win with vibes. You will with receipts, timelines, and rules used on purpose. The geography of extraction. Case maps without hype. Maps don't lie, but models can mislead. So let's walk a few streets and watch how the letter, the lapse, and the buyer line up. No scare graphics. Just invoices, binders, and who shows up with cash when clocks start. Foothills first. A western metro's rim where brush meets fence lines. For years, quotes rose, then non-new renewals bunched after a model update tied axis and sloped to a higher wildfire tier. Households fell to the fire plan pricey, structure only. A retired teacher sold a second car to cover it, then saw escrow jump anyway. Listings shifted to as-is. Agents started adding roof age and clearance notes up front. Cash offers arrived from LLCs with short inspections. Buyers didn't blink at ember vents or Class 4 replacements. They buy those in bulk and insure on a master program. On paper, hazard explains the cost. On the ground, ownership concentrates where coverage thins. Slide to the coast. A low street sits inches above king tide. FEMA's risk rating 2. Reshaped flood bills house by house. Private flood pulled back from the most exposed slabs, repriced the rest. Homeowners got a second hit when wind deductibles moved to percentages. One family priced elevation 6 figures. Waitlist, grants uncertain. They bound NFIP, swallowed a 2% wind deductible, then watched an escrow recast shove their payment over a line. 2 blocks inland, newer pads and hip roofs earned credits. Same town. Different math. Cash-only signs popped near the water. Rental signs followed. Now hail belts. Plains Calliope ESACs where summer sounds like a drumline. Renewals arrived with 1 to 2% wind/hail deductibles. And, quietly, roof ACV riders. After a storm, one block learned cosmetic means no new metal door, even if it looked like a golf ball. A roofer who knows Class 4 paperwork got 2 households small credits by documenting shingles, vents, and nailing. 4 neighbors couldn't float roofs this year. 1 missed proof. Force. A placed. Hit. The escrow jump killed a refi they needed to fix the roof that would have lowered next year's quote. A local buyer's card promised, "We handle roof work." 2 weeks later, an LLC tied to a known SFR platform closed. Urban heat islands next. Think 1940s grids, tight lots, brittle roofs, hydrants behind hedges. Loss ratios crept on small water and theft. A vendor roof mage table mismaged. Swaths by 5 to 8 years. Renewal bots flagged old roof. No updates. Appeals needed receipts many didn't have. Surplus lines stepped in with higher deductibles and leaner forms. A few missed the 30-day proof window. LPI backdated. Escrow recalced. Autopay posted partial. Late fees landed. On the MLS, ESWIS clustered where non-renewals had spiked. Rehab crews with tight scopes showed up at dawn. The block stayed busy. Owners changed. Southeast stacking, flood plus wind. A cinder block strip with flat roofs and older windows sits a mile from a 1990s tract with hip roofs and shutters. After a heavy season, named storm deductibles appeared and shutter credits mattered. The 1990s tract got relief. The older strip got price pain and fewer quotes. NFIP rose for the lower strip. Private floods stayed with the newer. 2 families bounced between fire and force, placed inside 90 days. An acquisitions analyst plane, he mapped those addresses against price cuts and needs roof remarks. A calling list wrote itself. Desert canyons. 1 lane washed after a burn scar winter. Access dials ticked up across a whole valley. Non-renewals bunched, not because flames were at the door, but because engines had one way in. Fire backstopped. Thin, but there. Quotes wouldn't budge until the county reopened a second lane. Some owners could ride the year with savings. Others read the servicer letter, then the cash buyer text. A few months later, the same hazard lived under a master policy with a 6-figure deductible the platform can pay. A quiet suburban micro map shows the loop's cadence. January treaty renewal. March model version rolls out. April appetite screen tightens on 3 zips after correlation toggles. June non-renewals land. July 30-day letters. August escrow spikes. September ASIS listings rise. October quick closes. The ridge didn't move. The filing calendar did. Notice what didn't happen. No secret call. Just incentives in sync. Reinsurance tightens. Models get conservative. Ratings guardrails bite. Carriers prune. Servicers enforce. Floors from lender in place to keep collateral insured. Then, capital with patient cash and scale insurance buys where clocks run loudest. Every step is legal. Together, it drains cushions from the same blocks, year after year. There are pockets that bend the curve. A Mountain HOA voted Class 4 on replacement, ember vents required. 5-foot non-combustible zones. Reflective addresses, hydrant clearance. They shot dated photos, logged permits, and sent a packet to carriers and the state. Quotes still rose, but appetite reopened a notch. In a floodplain town, a city-chased community rating system points, culvert cleanouts, tide valves, public maps, and NFIP bills eased across whole neighborhoods. Underwriters like disciplined clusters and lower baseline hazard. The map softened, because receipts did the talking. So the geography isn't fate. It's filings, dials, and clocks layered over roofs, driveways, and paychecks. If you harden where the model looks and bind something fast when letters land, you buy time in places where time is the most precious thing on the map. Hembietzier deku kost bakfatstheim. Detzier Cyrus Bachstadt C. Detzimt Orface. Thenens Punny Deku Bosht. Niogien. Detzimt Chepis is the most precious thing on the map. Mortgage covenants and escrow shock tash amplifier in the loop. While you're fighting quotes and forms, your mortgage is sitting there with one line that never blinks. Keep continuous. Hazard insurance. Miss it, even for a week, and the servicer can change your bill without asking. Not next year. Next month. That's the amplifier. Here's how a normal Tuesday turns expensive. Your premium used to spread across 12 months in escrow. When a renewal spikes, or a force-placed back-end bill lands, the servicer runs an escrow analysis. They plug in the new annual number, add any backdated shortage, and recast your payment immediately. Principal and interest didn't move. Taxes didn't move. But the escrow line balloons and drags your total up mid-year, right when your paycheck didn't. Micro is seen. October 12th, a lender emplaced policy posts at triple retail. The servicer advances $3,600 to keep coverage and stays compliant, then spreads that shortage over the next 12 months. Monthly jumps $300 for the shortage, plus $100 for the higher ongoing premium. You were fine at $2,150. You are not fine at $2,550. One recalculation flips your budget from tight to broken. Debt-to income doesn't care about context. DTI just rose because the payment did. That can block a refinance you needed to escape an arm reset, or kill a HELOC that could have funded the Class 4 roof and ember vents the model wants. The covenant meant to protect collateral ends up choking the fix that lowers risk. Arms make it worse. If your teaser ends while escrow spikes, you take both hits. Index lifts principal, and insurance lifts escrow. 2 lates in 90 days and automated delinquency letters start. The grim irony: nothing burned, no hail fell, and yet you're distressed. Servicer incentives aren't a conspiracy, they're math. They're paid to track coverage, cure lapses, manage shortages, and collect late fees. That stack won't turn a call center rep into a villain, but it does mean the system moves fast to add cost and slow to unwind it. Appeals stall in a vendor inbox. The ledger keeps time. Investor rules box them in, too. If your loan sits in a trust with strict guides, the servicer must force a place on schedule. Discretion shrinks. Even if a human knows your fair binder hits Friday, the script bills Wednesday. Computers don't grant grace for almost. This is where small delays become foreclosure math. Day 1, notice. Day 30, force, placed and backdated. Day 45, escrow reanalysis posts. Day 60, full new amount due. If autopay sends the old total, the portal treats it as partial late, stack 2, and a score dips while you're shopping coverage. The loop locks. Human beat. A borrower binds a fair plan on day 52. Uploads, emails, calls, gets a ticket. The vendor's SLA is 10 business days. November still posts with LPI on the ledger. They pay principal and interest in full, escrow short. Late fee lands anyway. 2 weeks later, LPI cancels retro and a refund drops into escrow. The servicer recalculates again. The family finally breathes. It took 2 paychecks, 3 calls, and a complaint. So how do you blunt it? Treat escrow like a second budget, not a black box. The day a non-renewal lands, call the servicer and ask for an escrow projection with scenarios. If premium becomes X, what's the new total? If LPI hits at Y, what's the shortage spread? Get numbers, not vibes. Then, pre-def fund what you can. A one-in-time escrow deposit can cut the shortage line and keep your monthly from leaping. Next, separate autopay. Turn off total due pulls until the dust settles. Manually pay principal land and interest in full. Pay escrow as much as you can while refunds process. Portals often apply partials badly. Don't let math label you late. Ask for a short, no advance collection note on the account while proof processes. Some servicers will. Many won't. Ask anyway and write down names. Paper is leverage. Upload binders, email them, and call for a reference number. Title files the same way every time. Proof, _, of, _, insurance, _. If LPI cancels, demand the refund straight into escrow and an immediate reanalysis. If they stall, file a state insurance complaint and a CFPB complaint with your packet attached. Phone calls vent. PDFs move money. One more move shift timing on purpose. If your renewal month collides with an arm reset, talk to your agent now about binding early or splitting payments to avoid a single brutal spike. Ask your county about homestead or tax installment options to smooth the other leg of escrow. Because the covenant won't change. Clocks won't slow. Your edge is timing, tickets, and cash and flow triage. The builder's toolkit aimed at the exact lines the ledger reads. Ownership levers. Short-term shields buy time. Now build bones that calm models, steady cash flow, and make you harder to price out. Think shell, systems, paperwork, cash buckets, title hygiene, and neighbors. Ownership is a system, not a vibe. Start with the roof. When you replace, pick Class 4 impact-rated shingles or metal documented as Class 4. Photograph layers, underlayment, nail pattern, ridge, and flashings. Keep the permit and the paid invoice. Add a secondary water barrier where code allows. If you're not replacing yet, repair lifted shingles, reseal penetrations, and fix drip edges. The model can't see hope. It sees edges. Make openings stronger. Ember-proof vents with 1/8-inch mesh. Box and soffits. Upgrade garage doors to wind-rated units. They keep roofs on. In hail belts, thicker gauge metal or Class 4 products beat builder grade. In fire zones, dual one-pane tempered on the fire side helps. Log skews and take photos before trim goes back. Tame the first 5 feet. Build a non-combustible zone around the house. Rock, pavers, bare dirt, not mulch. Break wood fences with a metal gate or a steel section at the wall. Swap wood chips for gravel along the drip line. Clean gutters, cap with metal guards that won't melt, and photograph the line empty. Date the shot. Edges win fires, drainage wins floods. Grade soil 5% away from the slab for 10 feet. Add splash blocks or drains so water moves, not pools. In older grids, install a backwater valve if code allows. Map your downspouts and low spots. Shoot a short video in a storm to show flow paths. A 30-second clip beats an argument later. Systems matter. Replace brittle supply lines with PEX or copper. Add smart leak sensors under sinks, behind the washer, and by the water heater. Install an automatic main shutoff It pays for itself one Saturday. Upgrade the electrical panel if it's outdated. Label circuits, add AFCI, GFCI where required, and strap the water heater. Carrier checklists love tidy service panels. Access counts in the model. Measure hydrant distance and driveway width with a tape. Trim back to 12-foot vertical and horizontal clearance if engines need it. Post a reflective address number visible from the street at night. Snap photos with the tape and frame. That's proof. Looks fine is not. Power is sanity. If you can swing it, add a transfer switch and a backup plan battery plus solar and fire zones. Generator where it's safe to store fuel. Label priority circuits fridge, internet, lights, garage, medical gear. Take a panel photo after the labels go on. Date it. Now turn craft into paperwork. Build a perpetual packet annual photos. Hunt. Back. Sides. Roof. Vents. Soffits. Gutters. 5-foot zone. Clearance. Hydrant tape. Copies of permits, invoices, SKUs, and a one-page inspector note. Title it mitigation_year.pdf. Send it to your agent 60 days before renewal. Ask for a named underwriter review. You are preloading their decision. Fix data hygiene. Audit assessor records square footage, roof year, additions. If a table misnames your home, correct it with permits and photos. Ask your agent to submit a data correction endorsement and to remove the roofage penalty. Save the yes. Cash beats clauses. Open a high-yield savings labeled Deductible_Fund, automate deposits. A 2% win deductible on $500,000 is $10 grand. Pair your base policy with a small parametric cover for wind or quake that pays on triggers. That drop of fast cash turns panic into a plan. Form the moat in the policy. Push ordinance or a law to 25% or 50%. Lift additional living expense to 18-24 months, or a higher cap. Add water backup and service line. Ask for a matching or line-of-sight endorsement. Kill roof ACV riders if you can. If not, size your fund for the gap. Get managed repair opt-out terms in writing before a claim. Tidy title now, not later. Record a transfer on a death deed if allowed. Fund the living trust you already set up. Retitle the house and cash accounts. Add payable WAN death designations to an emergency escrow account your successor can reach on day one. That buffer stops panic borrowing when timelines slip. Ritualize the calendar. Spring roof edges, vents, gutters, photos, and pack it to your agent. Summer. Defensible space and drainage. Fall specimen form review. Quote compare, escrow projection request, deductible fund top up, and parametric check. Winter backup power test. Leak sensor test. Panel labels audit. Boring saves addresses. Build neighbor leverage. Standardized class 4 on replacement. Ember vents required. 5 U-foot non-combustible zones. Reflective addresses and hydrant clearance. Host 2 clearance Saturdays a year, before/after photos, tape and frame. Submit a community certificate to carriers and the state. Underwriters like disciplined clusters, appetite reopens a crack when a street behaves like a portfolio. Pick your vendor bench now. One independent agent with admitted and surplus lines. A roofer who knows Class 4 paperwork. A mitigation inspector who signs fast. A drainage pro who solves slope, and a handyman who photographs everything. Share contacts on the block. You can't stop weather or spreadsheets. You can build to their checklists, fund the pain points, keep clean records, and move as a street. That's long-term resilience that prices in your favor and keeps your name on the deed. The new risk class divide. 2 paths now, clear as daylight. On one side, insured at scale platforms with master policies, fat deductibles they can pay, parametric layers and reinsurance friends on speed dial. On the other, households pushed into thin fair plans or foursome-placed floors that bill first and fix later. Same storm, different wallet. Here's the quiet filter insurability. Not a stamp, a score. It bakes in roof age, hazard flags, past claims, even wrong vendor guesses. If the file is clean and documented, you get an offer. If it's messy or silent, the price says no without saying the word. Lenders and carriers don't deny you. They make the number unlivable, which is the same thing if you're paying in real life. Watch how equity converts. A non-renewal lands. The lender's 30-day letter starts. Escrow recasts mid-high year. A refi shuts just when you needed roof cash. A buyer with patient money texts. Cash, esuis, close fast. Del Maro mine money. Del och pension say. Och caro, with listrat condis. Debts keep tash mines. No K for Navarres. Del care fix say. Your years of payments turn into inventory for a fund that insures at scale and smooths risk across thousands of doors. That's the divide ownership with options versus ownership on a timer. A kitchen table is the turning point. The quote shows a 2% win deductible and a premium you can't float. The agent needs 6 weeks for credits. The lender gives you 30 days. The buyer gives you Friday. Pick one. That's not a market theory. That's Tuesday. Incentives cement the gap. Permanent capital steers appetite upstream, then buys downstream volatility. Force and placed creates a floor that keeps notes safe and returns stable. Models hide behind trade secrets. Rating rails demand tail cushion. Each piece is rational alone. Together, they sort who stays and who sells. But this is also where the counterplay lands. Receipts and design flip flags. A Class 4 roof with photos and a permit knocks a penalty off. Ember vents and a 5-foot non-combustible zone move a wildfire tier. A fair binder pauses the clock. A labeled deductible fund turns a percentage clause into cash you already saved. An HOA standard turns a street from random risks into a disciplined cluster carriers will quote again. So pick the lane on purpose. Passive premium pair, hoping next year is kinder, or active risk manager with a 90-day shield and a long-term build. One path lets a spreadsheet decide. The other turns receipts into dials. Neither is easy. Only one changes the ending. The line that decides it is simple. If risk can be priced, it can be steered by you, or by someone who profits when you can't. The divide isn't faked. It's timing, paperwork, and cash flow. Move early. Move documented. Move with options. That's the climb out. That decision at your sink echoes for years. Insurability now shapes who keeps equity and who sells it on a clock. If you want leverage, build your 90-day shield tonight. Screenshot the checklist. Share this with one neighbor in a non-renewal ZIP, and start a 2-house code hop tomorrow. Subscribe for field guides that turn fine print into a plan. Next up, parametric microing covers and community captives that fund deductibles fast.